Netflix's stock in the last few years has exploded in success. When we look at the success in Netflix's stock, it's primarily due to the excitement revolving around their subscriber growth, as well as their top-line revenue growth. However, while investments have been drooling in excitement over the growth Netflix has been experiencing, it seems that many people have forgotten or turned a blind eye to the risks associated with the stock. In order to differentiate themselves as a brand, Netflix has undergone a lot of efforts to be recognized not only as a content provider, but as a content creator. They don't want to be seen anymore as just the guys in the middle that provide you movies and TV shows that others create. They want to be the sole creator, the nucleus in regards to content. And they're largely doing this in anticipation of increased competition. For example, Disney has already agreed not to renew its contract with Netflix. So starting in 2019, Disney will be pulling out the vast content that they own from the Netflix platform. Bob Iger, Disney's CEO, has already expressed his intentions for Disney to create their own subscription-type entertainment platform. Now, in creating and buying all this content in the last few years, Netflix has experienced a huge upsurge in its capitalized cost. According to Bloomberg reports, Netflix has about $20 billion on content expenditures. Netflix is indeed competing with the big boys now. If you look at Netflix in 2017, the non-sports programming expenditure was at $6.3 billion. Now, many investors and many market experts will say, well, Netflix is investing in growth. And for growth stocks, it's completely natural for them to experience a lot of debt in aims of being profitable in the future. And this does make sense in theory, but if we look at revenue growth for Netflix relative to capitalized costs, from 2015 to 2017, capitalized costs grew 140%, whereas revenue only grew 72%. Simply put, costs are growing at a pace faster than revenue. Now, this doesn't really show up on Netflix's income statement because Netflix has gone through some accounting gimmickry in order to spread their capitalized costs over a longer period of time, therefore making the cost per period a smaller amount. This enables Netflix to show a profit on their income statement and pretty much make their financial reporting look a lot rosier than it actually is. So although Netflix does choose to spend just as much as the other big media and content players, they don't really have the cash flows to support it, unlike the big media and content players. If we look at the free cash flow of Netflix relative to Disney, we can see the huge discrepancy in the profitability that these two firms experience. And yet they're valued at almost the exact same valuation in the stock market. Netflix's expected 2018 cash flow deficit is expected to be around the ballpark of negative $2.5 billion. Now, if I was a shareholder of Netflix, I would see this as a worrying point. You have a competitor in Disney who has the desire and intention to disrupt your market. On top of that, their free cash flow is about $12 billion more than you. So not only can they outspend you, but they already have strategic content that has taken the market by storm. In the last decade or so, Netflix has relied heavily on cheap financing in order to funnel their growth. Interest rates were kept artificially low by the Federal Reserve for a very long time, and Netflix took advantage of this. However, there are a couple of things that are changing. One, interest rates are rising, which means issuing any new debt will be more expensive. 2. Netflix has been untested by a formidable opponent. There have been small players in this market such as Crave TV, Hulu, etc. However, once Disney enters this market in 2019, that will all but change. And number 3, it seems like Netflix is steering into a brick wall at a fast and accelerated rate. They have quite a problematic dilemma, as Disney has the right to pull its content from Netflix's platform in 2019. They have one of two choices. They can either try and sustain their growth in revenue by issuing continuous new content, which will only further increase the risks associated with their expenditures, or they can slow down and try and address this problem. But that poses risks in that the platform becomes less attractive to the consumer. Either decision seems to have a downside. You either try and compete with Disney, who are financially more resourceful than you, or you have to face reality and accept the fact that you can no longer keep up this level of spending and growth. One thing that we can confirm that they have announced is they plan on undercutting Netflix. So you have to ask yourself, if Disney, with all the content that they own, introduced a streaming platform for a fraction of the cost that Netflix has, wouldn't you be interested in at least checking it out? And that's all it takes to put a dent into Netflix's stock. You have to understand the thing with growth stocks is they are great stocks to own until they stop growing or until growth slows down. And if Disney can't take a chunk of the market from Netflix, that's enough for investors to finally realize the risks and for the stock to normalize. After all, its price to earnings ratio is at about 230, so it is, in market relative terms, very overvalued. The thing about these stocks is nobody knows when they're going to come back to earth, but when they do, they come back hard and they come back fast. Now, as I said, Netflix technically does make a profit, and that's largely because their capitalized costs are stretched over an extended period of time. It doesn't really show up on their balance sheet in that regard. However, when you look at their free cash flow, it tells a more accurate scope of the story. Free cash flow and debt are kind of like two sides of a teeter-totter, where the strength of one can send the other one flying in the opposite direction. And that's exactly what we're seeing with Netflix. Here are some stats to back this up. Netflix hasn't been cash flow positive since 2009. If we took the cash flow positivity that they had in 2009 and used that as a rate to pay off their debt and content obligations, it would take about a century to pay off these obligations. The same ways that consumers often swipe their credit card and spend more than they can afford, Netflix is kind of doing the same thing. Now, of course, no one actually expects Netflix to take a century to pay its bills. Netflix supporters expect the company to grow so large and powerful that it will eventually generate far enough cash to pay for all these program obligations. But as we've compared Netflix's cash generation, or lack thereof, and the hard cash that it owes in the coming years, it illustrates the gamble Netflix is taking with investors' money, rather than its own. Netflix has been able to splurge on hiring Hollywood stars and to release a flood of new series and movies because the company has been able to grow money cheaply. The long-term debt, which now stands at $6.5 billion, is how Netflix is expected to finance itself for several years. And analysts at Bloomberg say they expect Netflix to tap up about an additional $2 billion in debt this year. Here's the conclusion I have about this. The more Netflix relies on borrowing to sustain its growth, the more pressure it faces to keep growing, to make sure that it can pay what it owes. And to be fair to Netflix, they have addressed and have been transparent about their need to borrow money for the foreseeable future to pay its bills. Netflix hasn't done one of two things though. They haven't been able to address the two risks associated with their stock. One is the fast subscriber growth, which may slow down, and two is the easy to borrow cash. The more debt a company has, the more riskier the market sees that company being, and therefore the higher premium they require on the debt that the company issues. So in other words, debt becomes more expensive over time, the more you have of it. So then the underlying question becomes, how much growth is left in this bad boy? Obviously, nobody can tout the success it's had up to this point. One final thing I'd like to add is there has been a huge increase in insider selling activity in the last 12 months. In 2017, we've seen an increase of about 12.5% in insider selling activity. This is essentially insiders selling the shares that they own in Netflix. Now, oftentimes insider selling isn't really a big deal, but when it happens in large volumes, it begins to raise questions. We have to assume that insiders are very smart and very experienced people in the businesses that they run. And given the fact, like all people that they are probably self-interested individuals, they also have access to the most information relative to the public markets. If the growth prospects associated with Netflix are so astronomically large relative to the risks, why would there be such a huge increase in selling activity rather than buying activity? After all, everybody is in this to make money. But if you're looking at this from the perspective of the insiders, maybe they're seeing that there's less money to be made now than there ever has been before. All great stocks slow down eventually. As Warren Buffett would say, trees don't grow to the sky. A rational investor needs to know both the risks and the positives associated with the stock. Whenever you turn a blind eye to one side, this can lead to a very costly mistake when managing your investments. The more likely you are informed to both sides of the argument, the better your investments can be. The purpose of today's video was just to show you the other side. So I want to thank you guys all for listening, and I hope you guys have a nice day.